Hi, thank you for joining us today. We wanted to take a minute and put together an update and an end of year tax considerations for our business owning clients. Now, this is, as you are probably aware, a really unique year for this kind of planning. Typically, year-end tax advice is not all that difficult to give. You're relying on some of the things that are standard in any given year, and we will certainly talk about some of that stuff. But it's a unique year in that there has been so much turmoil politically about what the next tax year is going to look like. So we're going to talk a little bit about that. Things are changing all the time. They changed today. They will change tomorrow. But I think, despite the fact that I have made this claim in the past, I think now we have some clarity about the direction of 2022, what we expect those tax laws to look like. And surprisingly, they're probably going to be relatively similar to this year. So we'll talk a little bit about that. We'll talk about what we thought was going to happen. We'll talk about what we see now. And then we'll get into the issues that, again, our business owning clients should be thinking about at year end. So let's get started. For the update, I'm going to go over a couple of things. First, again, some of the proposed changes that we thought were coming for a very long time. Once Democrats were in control of Congress and the White House, we thought they'd be able to pass their agenda, essentially. But there has been some dramatic evolution in the way that party has tried to put some of these things in place. And so we end up with some changes that we really, changes that we didn't expect, and then a few things that we didn't really see coming. So what we thought we were going to get, and if you've seen anything I've put out in the past, I certainly thought we were going to get a higher income tax rate. I thought we were going back to the Obama era administration. I thought we would see an increased capital gains rate. One of the things you probably know is that the Biden administration had created this full frontal assault on capital gains rates, saying it was a tax rate for the rich. So we expect there were a number of proposals to increase that capital gains rate. Those are gone. We expected that those very, very high estate tax exemptions that we have now, again, almost $12 million per person, we thought those were coming down to about 6. They're already scheduled to come down in 2026, so we thought we were going to lose them next year. Other things we were concerned about. Thought we might lose like-kind exchanges, thought we might lose 1031 exchanges. That's the idea for our commercial real estate investors, that if you sell a piece of commercial real estate, as long as you reinvest those proceeds in another piece of real estate, then you don't pay any capital gains. We thought that a lot of the wealth planning techniques that we have in place that help those clients of ours who own closely held but valuable businesses, real estate investments, trying to ensure that while the value of those continues to grow, their estate tax liability does not continue to go up right with those values. Thought we were going to lose a lot of those strategies. And then ultimately, we thought we would lose a basis step up that occurs at death. The Biden administration very clearly positioned that as the biggest loophole in the entire tax code. That's the concept that if our client inherits a $10 million piece of property, if she inherited it from her mother, who only paid $1 million, well, our client's basis in that real estate is $10 million. It's the value of the real estate at the time of her mother's death. And that means that $9 million of capital gains does not get, there's no capital gains tax on that. So that is positioned by the Biden administration as a loophole. Certainly it is. It's tremendous tax savings for a lot of families. Now, as I always say as an aside, if you paid an estate tax to get that basis step up, that seems more fair. But right now there's such a dramatic diversion between basis step up considerations and the estate tax that the two really don't meet any longer. So what ended up happening is we got none of that. So let me talk a little bit, at least in what we've seen out of the House and what we expect to see from the Senate, and we believe we've gotten buy-in from the White House on this. None of those changes that we were almost certain would be there were there. Here's what we have from an individual level first. The only increase in taxes that hits sort of that hits an individual is a 3% surtax on income above $10 million and an 8% surtax on income above $25 million. Now, that is positioned, of course, as an additional tax on those who make more than $10 million, more than $25 million a year. And that's certainly true. But we all recognize that to make more than $10 million a year on a regular basis, that's pretty rarefied air. Not many Americans are in that category, but there are a lot of Americans who will have a capital gain event that may be in excess of $10 million. We have lots of clients who might choose to sell that closely held business that they've worked so hard to build, might choose to liquidate some of the real estate investments that they've got. They could absolutely see income that's in excess of $10 million. And for those, this surtax is essentially just an increase in the capital gains rate. It's not positioned that way by any of the people, by any of the proponents of this bill. It's positioned again as though it only hits those who have this gigantic income level regularly. But to be clear, it affects anyone who has that amount of income in any given year, which, as I said, means that to the extent it has real impact on most Americans, it will be because, or not most Americans, but the vast majority of the impact will be on taxpayers who have one liquidation event that gets them into that level of surtax, and then again, as I said, essentially increases their capital gains rate. Another change that is actually a tax decrease, and there's a lot of sort of consternation around this because the Democratic proposal, that concept was we are not going to increase taxes on anyone who makes more than $400,000, or anyone who makes less than $400,000. You know, the wealthy need to pay their share. Well, they've actually proposed an increase in that SALT deduction. We all probably know that we're capped now at $10,000 of state and local tax deduction. That would be increased all the way up to $80,000. Now, that's not the unlimited SALT deduction that we had in the past, but it's a pretty big increase, and it will probably catch the vast majority of the people who are taking advantage of SALT deductions in the first place. So this is really going to hit those high income tax earners. It's going to provide a savings there. I won't get into how the way that they're pushing out the impact of this bill so that it's revenue neutral, but essentially it is a tax cut, and there's going to be a little bit of flack around that. But we think we're actually going to see that SALT deduction maintained, at least at some level. There is some pushback from certain senators, probably more to come on that. The interesting thing is that the only consistency that we have seen, and we have seen a number of proposals, we've seen legislative language on a number of occasions. The only consistency that we have seen is surprise, is the revelatory way that we see these new proposals and recognize that it's nothing like what we had anticipated. Okay, for business owners, there are a couple of changes that could actually have some impact, and it may be on a number of our clients who are in certain situations. So the first is this 3.8% net investment income tax change for our clients who own S corporations. This is a little bit unique, but there are a couple of different kinds of taxes that you all know and become very confusing and hit our clients at different levels. And one of those is the Medicare tax. There is a 3.8% Medicare tax that after a certain amount of earned income, after that, you continue to pay that 3.8% Medicare tax on all of your income. That's true for a pass-through entity like an LLC. All of the income that comes through will pay that 3.8% income tax. As part of the during the Obama era, when we were creating the Obama tax, the ACH, I'm sorry, the Obamacare process, the ACH, there was an addition of another 3.8% on net investment income. So those who earned income were already paying the 3.8%, and now those who have investment income also are blessed by paying that 3.8% tax. S corporations fell into a little bit of a crevice there because an S corporation is a pass-through. So you can imagine that I own an S corporation. Maybe it makes $1 million a year. Well, if that $1 million inside of the S corporation is there, I can choose to take that out in a couple of ways. One, I can pay myself a salary, and two, I can make a distribution to myself. I can make I make a dividend out to myself as the owner. So if there's $1 million in there, maybe I choose to pay myself a salary of $100,000, and then I make a distribution of $900,000. Well, the salary I paid myself, the $100,000, that's subject to all other employment taxes, including the Medicare tax. The distribution, however, is not just investment income. It's not just capital gains or dividends from some passive investment that I'm not part of. I'm actively involved in this S corporation. So that $900,000 is not subject to the net investment income tax currently. And it's also not subject to that Medicare tax. So there is this crevice in tax law that allows those exclusively with S corporations. It doesn't work for partnerships and LLCs, and of course, it doesn't work for earned income, that we could avoid that level of tax. And so within S corporation planning, there has been a lot of work around taking a small salary, large distributions because of all of the employment tax planning that can be done. Well, it appears that as it's definitely proposed, and it looks likely to pass, that they are going to essentially pave over that crevice, close that, what they perceive as a loophole, and put S corporation owners in that same position as other partners or LLC owners. More conversation later about whether or not that's going to impact the way we think about business structures, but that could happen. Another major change that could impact some of our clients who own businesses is the qualified small business stock exemption. I know what the Biden administration proposes as, the biggest loopholes in the code. I would tell you that this, to my knowledge, is the largest exemption in the code. I mean, you wouldn't call it a loophole. It's right there. It's written in the code. But it is the greater of $10 million or 10 times your basis in a company. I won't go through, and you have to be a founder of the company. I won't go through all of the requirements to qualify for QSBS, the 1202 stock. But I will say that right now, that $10 million that you might be able to receive upon the sale of that stock, if you qualify, that $10 million is entirely tax-free. There is a change in the new law that would bring that down from 100% exemption to a 50% exemption. Still a tremendous savings. And by the way, back to where it was when the concept was initially added to the code. The ratcheting up from 50 to 75 to 100% exemptions, that happened in years past. So now we're looking to bring that back down. The other thing that they're looking to do as part of that change is some individuals who had that company and qualified for small business stock want to take their own $10 million exemption, and they might transfer some of those shares into trusts for family members or others. And those trusts each get their own $10 million exemption if done appropriately. That there is an effort in this law to eliminate that QSBS exemption as well, and the ability to multiply it with the use of trusts. Same rules that we are now sort of used to regarding active pass-through losses. There were times when we could take active NOLs back. That's no longer the case. We can use them, of course, in the year, and then to the extent we can't, we move them forward, and we can use them up to 80% of next year's income, assuming we don't have any other deductions at the same time. So that looks like it's going to continue to be in place. And the only other thing I would want to point out, and it's not in this federal bill, but it is an important piece, and is this AB 150 within California. California has joined, I think now there are 15 or more states who have essentially enacted a law that allows pass-through entities to deduct their state and local taxes. Remember, when we're stuck at $10,000 of deduction for state and local taxes, we really, some of our business owning clients really got impacted by that. So the FTB enacted a law, or the legislature enacted a law that allows for essentially the pass-through entity to take advantage of the deduction by reducing the amount of taxable income that gets K1'd out. We have a whole video on that on the website, so I won't get into any more detail. Something interesting, though, is that this AB 150 from California has a self-destruct mechanism in it. It says, hey, if that $10,000 cap is eliminated, then this law goes away, because there's no need for it anymore. If we're able to take the federal deduction individually, we don't need this sort of gamesmanship around the pass-through entity. Well, that poison pill, that self-destruct mechanism, doesn't say anything about what happens if that cap goes from $10,000 all the way up to $80,000. That's an interesting circumstance. We could get a large exemption for individuals plus this AB 150 that allows us an unlimited SALT deduction inside of pass-through entities. So a lot to be looking at there, and those are some of the things we're going to need to be thinking about going forward. The good news about any of this is it doesn't impact what you need to be doing right now at year end for the most part, but those are changes that we should just be aware of. Okay, so let's get into the changes or the things that we should be thinking about towards year end. Again, none of this is magic. A lot of it is the same kind of stuff we see, but it is important this year, just as it is in other years, even though there is this lack of clarity around what next year's laws may look like. Okay, first and foremost, I'll get to the maximized contributions in a second. First, for business owners, if you're in a cash method accounting, if you can defer invoices, if you can defer income, right, it's not taxable in this year, it can be taxable in the next year. Now, I recognize, as so many of our business owners will say, look, if I can get the revenue, I need to get it. If I can get a client to pay, I need to invoice and get them to pay, especially with the amount of time that many of our clients take between the invoice and actual payment. So I understand that. But to the extent it's reliable and you can push those invoices out, or at least the receipt of those payments out, then we can push that tax into a different year. I should come back to a point that I forgot to make initially, which is because we don't see the income taxes going up necessarily, assuming we're not in the $10 million range, then we are kind of looking at, well, we're back to our sort of standard tax totem, which is defer gains and accelerate deductions. That is just sort of general rule. Now, we thought there might be an exception to that, because if the income tax rates are going to increase next year, then maybe we want to incur these taxes this year. It doesn't look like that, so we're kind of back to our standard push income out, accelerate deductions to the extent you can. My caveat is I didn't think we'd be here. I was entirely surprised by what I saw earlier in the year, which means I could be entirely shocked by what comes in December. Though I've been wrong on this on multiple occasions, I would find it very difficult to imagine they would increase tax rates. Just watching the political machinations that got us to where we are today, that got us to the Build Better Back Act, if that is a mouthful, that we have today, the way that has been pared down, it's really hard for me to imagine in this political environment that they're going to re-expand that when they're just trying to get, essentially at this point, senators to sign off, senators who are objecting to larger tax increases. But it's always possible, so take what I say with that grain of salt. Same thing as far as reducing income or deferring income. If you have capital gains assets with gain that you're going to sell, maybe we wait. Don't sell them in December, sell them in January, so we get that extra year. Again, deferring gains in the same, when we're going to be at the same rate, is always advantageous just from a time value of money perspective. So as long as we don't think those rates are going up, that's the advantage. Let's push out those gains. The other thing, of course, you can do to reduce the tax burden is accelerate deductions, as I said. So if we have less taxable income, we have less tax. And maximizing contributions to qualified plans is one way to do that. We're going to talk about that in a slide coming up. But of course, the concept is you get a deduction for any contributions you make to those qualified plans. So make those contributions, let the plans grow tax-free. And again, we'll get into that in just a little bit. If you have investments that have come down in value, that are less than the basis that you paid for them, and you want to sell them anyway, tax loss harvesting. Think about selling those. We'll talk a little bit about that in a minute as well. Take advantage to the extent possible that we can use some capital gains against ordinary income. Incur deductible business expenses. If you've got expenses you know are going to hit in January, February, if you can take those in December, great. If you can put equipment into service now, get the 179 deduction, that 100% deduction in the year, and you have the income to use it, then think about that as well. And then finally, get deductions, get those charitable deductions. If this is a big income tax year, let's create some strategies that will allow us to set money aside for charities, but do it in this year and get the deduction this year, even though we don't have to give that money away until the future. And those are donor advised funds. We'll talk more about that in a minute as well. Things that are specific, what we've been talking about so far is in many ways applied to a lot of income taxpayers, but specific to businesses, remember those NOLs, remember the limitations we have on them, they have to carry forward. So do the math, work with your tax advisor. That should go, that should be sort of an unsaid statement throughout this presentation. Work with your tax advisor to understand the implications of this, obviously. But do the math, run the equations so that you can see when is the best time to have these to the extent you can time some of those expenses. Maximize 199A deductions. There's a lot of complications to this. It's a qualified business income deduction for small businesses. There are phase outs, but if you have the right kind of business, if you employ a lot of people, or depending on the way that you operate, you may be able to take some advantage of this and make sure that you're doing that. And then finally, at the end of the year, as you're thinking through all these issues, let's look at the overall business structure. So I mentioned this before. Think about those changes that are coming perhaps to S corporations. Well, there are not a whole lot of advantages to S corporations in comparison with maybe an LLC that's taxed as a partnership or as a straight pass-through if you're a 100% owner. There are some, but there are not a whole lot of advantages. In fact, there are some pretty significant disadvantages in the way that you can move assets in and out of a corporate structure like an S corporation. So if we had that S corporation in place for a long time, it was probably because we were playing the compensation game. We were using those advantages, those small narrow lanes that we talked about. Well, if those lanes are gone, if that advantage is gone, we may want to consider recapitalizing that entirely. The other thing that should go should be throughout this entire presentation is, to the extent you have questions about this, please give us a call. We're happy to talk through your individual situation. All right. The other thing to look at, and it may be hard to pull this off at year end, but it should be something we should be thinking about throughout the year, is pay attention to those tax elimination strategies. So one of those is a qualified opportunity zone. With those got a lot of fanfare initially when they came out, and you don't hear as much about them now. And of course, many of our clients respond, even those clients who are in real estate development or real estate investors. When we've talked in the past about qualified opportunity zones, they'll say, look, I get it, but that's not my business model. I don't want to be investing in urban blight, areas that need gentrification, and I appreciate it. It's nice what they're trying to do. That's not what I do. I would tell you that you should not think about qualified opportunity zones that way. There are huge broad swaths of land that are qualified opportunity zones where there is, no pun intended, some great opportunity. For those of us in San Diego, a good example is, if you think about Petco Park, all the area to the east and to the south is a qualified opportunity zone. And if you think about what's happened to downtown, the way that continues to evolve, there could be some really good opportunities that happen to sit there. And in those circumstances, we can take capital gains and defer paying the tax. It's like a 1031 or a like-kind exchange, except these capital gains can be from anywhere. They can be from the sale of a stock or anything else. They don't have to be real estate. And you don't have to invest all of it in the qualified opportunity zone. You only have to invest the gain. You can have your basis back. That can go into your checking account. So it's a really impactful plan. You get to defer those capital gains, and in many ways, you get to eliminate those over time. Some of them, anyway. Also, I talked about this before, 1202 stock. To the extent you have a business, it looks like we're going to keep that going for a while, and ultimately you'd like to sell it down the road. Think about whether or not you can convert yourself into a structure that would qualify for 1202, for qualified small business stock. Now, there are some complexities to that. It's beyond the scope of this webinar, but you should be thinking about it. You should definitely have a conversation, especially if those kind of corporate structures that you have to put in place don't cause any issue for the kind of work that you're doing. We're working with clients right now who have their own LLC, they're starting a business, they're doing great things, they're starting to have success. And we're talking to them about the fact that if they make some conversions here, their life will be very similar to what it is today, but we position them to qualify for millions and millions of tax-free dollars down the road. Again, if you have questions about your specific situation, please give us a call. Okay. All right, we talked about this a little bit, tax loss harvesting. So this is a pretty common concept. At the end of the year, if you have those investments and those investments have come down from their purchase price, you can sell them and take the loss to offset some gain that you have somewhere else. Now, keep in mind, the big thing you have to keep in mind about stock sales is the wash sale rule. If it's a security, which all stocks are essentially the way that you think about them, if you sell it, you cannot buy it back for the next 30 days. So that stops people from essentially just selling and buying and then just capturing the loss wherever they can. I mentioned that unless it's Bitcoin, the IRS has not been entirely clear about this, but it looks like because Bitcoin is not a security, the wash sale rules as interpreted now don't apply to Bitcoin. That would also perhaps be changed with this new law, but it's not true yet. And what that means is, as Bitcoin, though it seems like cryptocurrency does nothing but go up, if you watch, there are times when you will see those vacillations. And if you catch it, if you bought it at the wrong time, you see a 20% dip before it goes back up, you can flip that investment perhaps and take advantage of the loss without really being out of the market for any amount of time. The other thing about stocks in general are, and the wash sale rules is, it's a great idea if you can sell out of certain technology stocks and then buy back into others, or you have certain ETFs that you can replace with something that's similar but not exactly the same. Those are great ways to take advantage of your loss now without worrying too much about it. If you don't have the if you don't have the assiduous personality to pay attention to when did I sell, when can I buy back, it may not be for you. What you do not want to do is let the tax tail wag the investment dog. You don't want to accidentally end up out of the market at a time when you should have been in. And that could be far more impactful than the tax savings that we're trying to create here. And then, of course, for business owners, are there capital assets that you can sell? Are there things you're looking to get rid of anyway? You may want to sell them as soon as possible to take that capital loss now to offset other gains. Okay, mentioned this before, qualified plans, right? So these are the typical plans you think of are like 401ks, IRAs. The idea is you take your ordinary income and you take some of it, a limited amount, unfortunately, but you take some of it and you contribute it to this plan. And you get a deduction for that contribution, meaning you are not paying tax on that today. It goes into the qualified plan, it can be invested, and that growth occurs tax-free, or at least tax-deferred, right? It continues to appreciate over time, hopefully, if we make good investment decisions. And then on the distribution out, that distribution is taxable to you. Well, where's the advantage? If I get a deduction now, but it has to be taxable later. Well, the advantage is you're probably in a higher income tax rate than you will be when you are taking these out maybe much later in life. And we got that deferred gain and that growth on pre-tax funds for all of that time. So if you look at you just run the numbers on it, it's really, really impactful to be able to stock away pre-tax funds and let them grow pre-tax before you have to take those out. Do recognize, of course, the distributions back out are ordinary income tax. So what do our business owner clients do? Sometimes we're familiar with how employees can deal with this and create IRAs and 401ks. Business owner clients can create solo 401ks or SEP IRAs. It's the same thing. The limitations work in similar ways, and it's not unlimited, but you can set money aside, deductible funds that will then grow tax-free. There is another advantage for those who have relatively high income from business and that's relatively stable. If we can project, if we can presage that we believe we're going to have that kind of income for years to come, a defined benefit pension plan can really be impactful because the deduction limits are much larger. Now, what you're actually putting in place is a defined benefit plan, a pension plan. And as you can imagine, true pension plans have a lot more administrative costs. There's the administration of setting it up itself. You got actuarial analysis you have to do. But again, it doesn't work great if we think that that income is going to vacillate wildly over time. If that's the case, that's typically not a great structure for a defined benefit plan. In fact, it can even sort of blow up on you, which is unfortunate. But if you have good, significant ordinary income going forward, and it's reliable going forward, then a defined benefit plan is absolutely worth considering. Also, sometimes discussed as cash balance plans. Okay, another couple things to point out about qualified plans are some features that are available. One is a Roth conversion. Now, this may not be a surprise to many of you. This may be something you've heard of before. Oops, sorry, I didn't do that. But the key is you could take some of those pre-tax retirement accounts, a Roth, an IRA. Maybe you had a 401k, you converted it into an IRA. We can take that and we can convert it into a Roth IRA. Well, what's the advantage of a Roth IRA? Well, a Roth is post-tax money going in, grows tax-free, and then is entirely tax-free on the distribution to the owner. So what's the catch? Well, the catch is, as I said, it's post-tax money, and this IRA we have is pre-tax. So the conversion is a taxable event. You will create, if you're converting $1 million, if you're converting $1 million IRA to $1 million Roth IRA, you're going to have an extra $1 million of ordinary income. That sounds bad, and it is, and you're going to owe taxes on it. But if we have those assets, those special qualified tax deferred, tax benefited funds, then what that essentially allows is, when you think about a Roth, you have that $1 million the $1 million I have in the IRA, it's not really $1 million. When I get that out, I'm going to pay ordinary income tax on all that. So the value, the after-tax value that's actually in there, is more like $500,000, $600,000 to me, to actual spendable money. If on the other hand, I take that $1 million and convert it, now I did have $1 million of ordinary income, and I have to pay the tax on that. But if I can pay the tax from other non-qualified assets, if I have the cash, the liquidity around to pay the tax on that, now that $1 million is really worth $1 million in a qualified account. And now that can grow entirely tax-free. And it will be tax-free when I receive it. And by the way, if I don't think I'm going to need that and ultimately want to get it to my children or family, this will be available to them entirely tax-free. We talked about that basis step up earlier. One asset that does not get a basis step up is those qualified accounts. If you have a big 401k, a big IRA, whoever the beneficiary is upon someone's passing, they still have to take the ordinary income tax that is due on those funds when they withdraw them. That's not true for a Roth. So there are big advantages to making that conversion. The other thing that can happen, the other thing that you can use qualified accounts for are charitable distributions. Now, this is not available for all of us by any means. First and foremost, you have to be 70 and a half when you make that contribution. But if you are there and you need, otherwise you have to take out your required minimum distributions on an annual basis, and you have to pay income tax on those RMDs when they come out. One solution is to say, if I don't need it, I don't want the extraordinary income tax, let me instead make a contribution to charity out of this qualified account. We help clients do that all the time. And what's the advantage there? Do you get a deduction? You don't. There's no charitable deduction for that distribution. But it does qualify as your required minimum distribution, and you get an effective 100% deduction. Because if I had to take, if my RMD was $100,000, I had to take it out, and then I just want to cut a check to the old Globe for $100,000. Well, I have to take the ordinary income in, then I have to figure out what my deduction is. We have to go through the AGI issues. Do I itemize or not? That has a significant impact on the amount of charitable deduction I could take. If instead I send it directly from the qualified account to a charity, none of that has any impact. I get an effective 100% deduction for those funds. And that can be really, really impactful for those people who don't need their RMDs, and we're going to get to charity anyway. Okay, some additional charitable giving issues, because of course, one of the best ways to reduce income taxes, to the extent you have philanthropic goals, is to make contributions to charity. So a couple things you should know. Number one, special law this year that up to 100% of your AGI can be deducted for cash gifts to charity. This is essentially an effort in the recovery post-COVID to get people giving again. Now, I don't know how many people are giving cash that were going past their 50% AGI already. There may be some that this inspires to give more. Also think about in-kind giving of stock. If I have $1 million of stock and I have no basis, if I sell it in order to get the cash I want to give to maybe the old Globe, well, I have to sell it and pay my capital gain. Well, I have to sell it and get $1 million. Then I make my contribution. Well, on my income tax return, though, I had $1 million of capital gain, and just like I talked about before, now I've got to figure out how much of my AGI I'm allowed to use, if I itemize or not. If instead I just make an in-kind contribution, I get I never have to take the income on the sale of the stock, and I get a full deduction for the value of the stock that I contributed. So I get $1 million deduction, and I didn't take on that $1 million of income, which means I have $1 million deduction I can use somewhere else. So it is far more effective than selling the stock and giving it away. I mentioned this earlier as well. If we have a big income tax year, and this happens a lot, sold a business, had a big year, anything where this is an unusually outsized income year, maybe we want to, in this year when we're flush, take a lot of those funds and set them aside for charity so that we can get the deduction this year. We take that huge tax bill and knock it down a little bit. Well, but if someone said, I sold the business for $10 million, I'd like to set aside $2 million for charity, but I'm not ready to give away $2 million. That's okay. We put it inside of a donor advised fund. By irrevocably setting it aside, we can choose to invest it however we want, but by irrevocably setting it aside, we get the deduction today, and we get to give that money away in whatever amount we want over the rest of our lives. There are no minimum distribution requirements, etc. That may change in the future, by the way. There's some pretty significant criticism of the fact that there's all of this charitable money awash in these accounts. But it is true, you can't have it back. So I'm not sure what the real concern is. But ultimately, you'd like to be able to get that out to charity. So take that. You can do that over time. And the other thing you can do, of course, is before you sell something, take some portion of it and get it inside the donor advised fund before the sale occurs. It's just like that stock issue I talked about. Now, whatever percentage is inside the donor advised fund, you do not pay capital gains at all, because the donor advised fund itself is tax exempt. It sells the asset. Now you've got those proceeds in there, and you get the full deduction for the contribution, depending on the structure. But you can take essentially a double deduction in that scenario. Again, if you have questions about that, please give us a call. And then a charitable remainder trust is another similar idea around that, and should be talked about far more often when our clients have philanthropic goals. Again, none of this is in an effort to get necessarily more money into your pocket. It's really about reducing tax bills and advantaging charity instead of maybe the IRS. So if you were going to sell a business, for instance, or a large piece of real estate, let's say you're selling a $10 million piece of real estate and you have no basis. So that's $10 million again. Well, we can sell that. We could pay the capital gains. We could pay California taxes and maybe walk away, call it $5 million, all after tax. Instead, we set up a charitable remainder trust. We take the $10 million of real estate, we put it in that charitable remainder trust. The charitable remainder trust sells the asset. Because the charitable remainder trust is a charitable entity, it does not pay capital gains taxes. So now the $10 million of liquidity that can be invested in any way that we choose, and over time, that charitable remainder trust pays an annuity back to our client. That can be an annuity over a term certain, or it can be for the rest of that client's life. Now, the payment back is taxable, and it's taxable in the same way that the sale would have been taxable, plus any earnings that might occur. There's some ways that that's handled. But what that means is you get to defer a vast majority of those taxes until the payments are made, which means you get to continue to reinvest those funds. Rather than having $5 million to invest, you have 10 that you can continue to invest and then pay your annuity over time. And hopefully we've made some good investment decisions and the remaining funds after the course of our client's life or after the course of that term, the remaining funds go to charity. That's why it's a charitable remainder trust. And so that can essentially put clients in a very similar situation, except they've cut the IRS, or they haven't cut them out, but they've significantly reduced ultimately what the IRS will get out of this, and instead shifted that to charity, which very frequently more aligns with our clients' goals. The only thing to keep in mind about that is my point that I made earlier, the value of what you receive is probably not greater than what you would have gotten. That is to say, if you sell the $10 million, you walk away with $5. Okay. Or I sell it inside of a charitable remainder trust and I walk away with the right to this annuity. The present value of that annuity is probably right around $5 million. So there is some advantage. You'll get more than $5 million over time, but it's not in your checking account right now. So the present value is about the same. Again, clients in a very similar situation than they would have been, but we got to cut the IRS significantly out and instead benefit charities. So a couple of other things that we got to remember towards year end is the giving structures. And you may be using this a lot. You may have talked about this and thought through it a lot, but it's one of those tax advantages that expires at the end of the year. And if we don't use it, it's simply gone. So you may know that every taxpayer can give up to $15,000 to as many individuals as they want without paying any gift taxes and without using that lifetime exemption that they have, which we'll talk about in a second. Which means a married couple can give up to $30,000 to as many of their family members as they choose. And again, we don't use up any lifetime exemption. And if we don't do it, it's gone. This annual gift exemption can be used to create some significant wealth, and a couple of different ways that's done. It's very frequent. You can make these outright, or you can make them into a trust for the benefit of family members. Now, there's a little administrative complexity that occurs when we put them in a trust, but it's not a big deal, and it's something that happens very, very commonly. But then that doesn't mean that our families have money in their hands. It means that it's in a trust for their benefit, set aside for them. We can use those funds to invest in life insurance so that there's a significant amount of income tax-free, estate tax-free liquidity at the time of the senior generation's passing, which can be really impactful in an estate tax and an estate planning strategies. Or we can simply set that aside and invest. We can even buy into the same kind of investments that we might be participating in ourselves, but now it's outside of the taxable estate and growing. And you can imagine, you take a married couple, $30,000 per family member, all of whom are beneficiaries of this trust. That can be a relatively large amount of money you can set aside over time. The other thing to think about I should mention too, to the extent we want to set that money aside for family members, very frequently that same senior generation would like to set money aside for education, health issues, things like that. First and foremost, you can always, you probably heard this before, but just keep in mind, you can always pay for health and education expenses. It has no impact on your lifetime exemption or on your annual exclusion. You can spend as much as you want without any gift tax implications at all. The only caveat is you have to spend it. You have to actually be paying the invoice to the institution. So you can't cut a check to granddaughter for tuition. You have to cut a check to the university for her tuition. The other thing that a lot of people think through is, well, I've got grandchildren, they're in grade school, they're not going to school yet, but their parents are worried about the expense of education in the future. So that's why we have those 529 plans. Those are special qualified plans. You put money into that account, so you can use your annual exclusion to put money into that account. In fact, you can use up to 5 times your annual exclusion in 1 year in case we call super fund that account so we can really get it started. You put that into a 529 plan. Those assets then are invested just like any other asset, and they grow and they grow tax-free within the account. And then if they are spent ultimately on education expenses, qualified educational expenses, you never pay tax on that growth. So not a whole lot of opportunities within the tax code to see growth occur and never pay taxes on it. So those are some of the things that a lot of our clients think about. And the other thing is to the extent you're going to be making gifts anyway, maybe you were going to be selling some stock and then ultimately want to make gifts of that cash. Keep in mind, we can make gifts of the stock itself into our family's hands. If we are going to put it in, if we are going direct to kids, let's say, well, maybe so long as they're not subject to a kiddie tax, we're talking about adult children who have their own income, but maybe they don't have as much income as we do, and therefore they're in perhaps a different capital gain bracket. Maybe they're still within the 0 capital gain bracket or a lesser for the 15% bracket. If that's the case, maybe we gift them some stock we would have had to sell anyway and let them sell it, take the after-tax proceeds. From a family perspective, that might be a relatively large tax savings, depending on your situation. Okay. This is maybe one of the bigger changes that we got from not having change. That is these very, very, very large estate tax exemptions that we have. So remember, we have now estate tax exemptions that are 11.7, almost $12 million per person, which means a married couple has, more than $23 million of estate tax exemption that they can use. They can give it away during life, or they could pass away with that and pay 0 in estate taxes. Now, we thought we were going to lose those large exemptions. We thought they were going to be cut in half as of January. Looks like that is not the case. It looks like we have until at least the legislated date, which is 2026. That means by the end of 2025, these are scheduled to be cut in half at that time. This is tremendously important and valuable for our business owning clients and our clients who have real estate investments. Certainly, no one wants to pay estate tax, but if you have $100 million in marketable securities, there's an untimely passing and we owe $40 million to the government, well, that's unfortunate. No one wants to pay that tax, but we have the liquidity to do it. We're not having to give up a family asset in order to pay those estate taxes. On the other hand, if we've been sweating and toiling to create this closely held but valuable business that we've been building, and of someone's untimely passing, this thing looks like it's worth 50, 60, 70 million dollars because of the appraisals that are happening right now, it would be a real tragedy to see that the family can't even continue the business because they simply can't afford the estate tax obligation. So those are the clients that we say, wow, we've got these large exemptions. Let's start taking pieces of that business and get it out of your taxable estate. I'm not asking you to give up control. I'm not telling you that you can't continue along the path that you were down before. And I'm not telling you you have to give anything outright to the children. You do not. But we need to set those things aside so that as they continue to appreciate, the IRS does not continue to participate in its sort of right of survivorship. I describe that for clients commonly as the government has a 40% right of survivorship on the appreciation that you're seeing. So let's get that tax monkey off the back so that we can continue to have this growth. And then if something happens, if there is an untimely death, then we can figure out a way to deal with the liquidity need for the estate tax, but that tax doesn't just continue to grow and become such a gigantic, onerous issue for the family as a whole. And I also mentioned this, we thought we were going to lose some of the strategies that were the most effective for stopping the increase in estate taxes as business values continue to appreciate, as those real estate investments continue to appreciate. It looks like we are going to continue to have those techniques, that we're going to continue to be able to put those in place at least for the next few years. And so we should be paying really close attention to where this is appropriate, because as you can probably imagine, these structures take time and they take some analysis. And so it's not the kind of thing that, as we figured out this year, when we thought we were going to lose them at the end of the year, it's not the kind of thing you can say, well, I got 3 months, let's put it in place. It's much more difficult than that. At least it's much more difficult to do it right. So we need to have our clients thinking about this. Many of our clients, you're going to hear from me in the new year to talk through some of these issues so that we don't end up stuck up against it like we did this year. Okay. Finally, I would tell you, no one likes doing this, but you should do it. As you're thinking through all of these tax issues, review your overall estate plan as well. Think about the people that you put in place. Think about some of those names that you put there as your personal representative or your executor. Think about the people who are beneficiaries on those qualified accounts. Did you set up transfer on death accounts to avoid probate. Let's look at that again and make sure that's still in line with your goals if something were to happen to you. That's an important piece of this. So there's a lot here. I apologize for having to race through it. I've done this in the past, and it goes on for an hour. So sometimes I just want to go fast so that we can just get through the information. And then if you have questions, if there's something we weren't clear about or you'd like more detail, please let us know. Obviously, I want to show you the disclaimer here, but I have said this on multiple occasions, but this is the most dynamic tax year of my entire career. We have been planning in environments that entirely evaporated on us. And then we're looking at totally new structures, and it could happen again. We might not yet know what the real impacts of 2022 are going to be yet. As I said before, because of the political issues that have occurred, because of the machinations, I suspect we do have some pretty good clarity. Spoiler alert, I've said that before. So don't take anything to heart yet. But I do think we're ready to start doing some planning. In any case, a lot of these things make sense under any circumstance. If you have questions, please talk to your tax advisors and then give us a call, and we'd be happy to walk you through anything here. Thank you very much, and we look forward to working with you.